Hi, welcome to Chapter 10, Foreign Exchange Markets. So, what are foreign exchange markets? I think we all realize what these are. If you've ever traveled to another country, you know that you're going to have to exchange your American dollars into that foreign currency. So, foreign exchange markets make it possible to convert one currency into another. So, an exchange rate is the difference between the two currencies' value. So, for example, if for a long time Canada's currency it would take um, only 66 cents American to make one Canadian dollar. And now the Canadian dollar strengthened, so it takes a full American dollar to equal one Canadian dollar or close to it. So the exchange rates are really the calculations of what it would take to convert one currency into another, and specifically how much of the other currency. So this is not a new concept. We're all familiar with this. For a foreign exchange market, really the purpose of it is to convert one currency to another. Because internationally, lots of businesses are doing business in many different countries, and these currencies have to be exchanged and repatriated, or for travel among different countries. These foreign exchange markets are there to provide the ability to convert one currency into another, and can also provide some insurance against foreign currency risk. I'll talk more about later. Okay, so currency conversion. This is what we were talking about before. If you want to be able to take your currency, say the U.S. dollar, and convert it to a foreign currency, and you're going to use this to pay other companies for products or services, it's a vital thing. Now, there are such thing as currency speculation, where people will bet on a currency, hoping that the change in the value of the currency will benefit them based on whether they bought or sold the currency. If you can predict exchange rates, are really difficult to predict, a really risky area to bet in. Now, in the currency markets, there's something called a hedging, or the ability to insure or protect against foreign exchange risk. And to protect yourself against foreign exchange risk, there are three basic market functions doing this. You have the spot market. We'll go back to that in a second. Spot, the forward exchange rates, and the currency swaps. So let's talk about the spot market. This is basically the cash market. So this is the rate at which the currency is currently converted at, and it's purely supply and demand, moving the currency values up and down like a stock. So the spot market is really what you would pay on the spot for that currency. And it's if you as an individual are going to buy a currency, you're not going to get a rate as good as the spot rate, because the banks will inflate the spot rate a little bit, so they can make profits on the exchanges. And the worst place to exchange your money is the airport. Sometimes it's very convenient for traveling to do that, but it's not really a great place to exchange your currency. And this spot market is, a 24-hour market where the prices are currently changing every day. Now, the forward exchange rates, this is where sort of a guess of where the prices are going to be. So, two parties could actually exchange currency and execute the deal at a specific date in the future, and that would be, a forward exchange. So basically, a forward exchange rate is what you want to pay for a currency, or two people agree to pay for a currency in a forward position. So that way, if say two people are going to make two businesses are going to contract for a large shipment, say $1 billion shipment of goods between two countries, they can actually get together and agree on the exchange contract rate ahead of time, before that's actually delivered, to kind of lock in or guarantee or insure against the currency exchange risk. in the time between when they first enact the deal to when they actually get the material. So there's no surprises in how much money, domestic money, they're going to have to generate to get the material or receive on the sale of material. Okay. Now, a currency swap is a simultaneous purchase of a sale and purchase and sale of a given amount of foreign currency for two different value dates. So swaps are transactions created between international businesses and their banks, between banks and between governments when it's desirable to move out of one currency and into another for a limited period without incurring foreign exchange risk. A common kind of swap is a spot forward, spot against forward, I guess as they call it. Consider a company such as Apple Computers. Apple assembles laptop computers in the United States, but the screens are made in Japan. Apple also sells some of the finished laptops in Japan. So like many companies, Apple both buys from and sells to Japan. Imagine Apple's need to exchange $1 million into yen to pay its suppliers for the laptop screens today. Apple knows that in 90 days it will be paid 120 million yen by Japanese importers that buy the finished laptops. It will want to convert these yen into dollars for use in the United States, although we know that Apple has billions and billions of dollars outside the United States that they don't want to repatriate because they don't want to pay taxes on it. So it's not always the case that they bring it back to the United States. They usually try to hold it in a foreign country to avoid paying taxes. But anyway, let's say that the spot rate is $1 equals 120 yen, and the forward contract $1 equals 110 yen. Apple sells $1 million to its bank in return for 120 million yen. Now, Apple can pay its Japanese suppliers. At the same time, Apple enters into a 90-day forward exchange deal with the bank to convert 120 million yen into dollars. Thus, the 90 days, Apple will receive 1.09 million converted for 120 million yen into dollars. Thus, 90 days, Apple will receive, I guess that 1.09 million. Because yen is trading at a premium on the 90-day forward market, Apple ends up with more dollars than it started with. But the opposite can occur as well. So the swap deal is just a convenient forward deal in one important aspect. It enables Apple to insure itself against foreign exchange risk by engaging in a swap. And Apple knows they're locking in the 120 million yen payment it will receive in 90 days for 1.09 million. So it's just these currency swaps are just a way to say, I know the markets are going to fluctuate. I'm happy with what the rates are. Let me lock it in at that rate so I know exactly what I'm getting. So it's a protection of sorts. Now, foreign exchange markets are not like stock markets, but the big difference is that they're 24-hour global markets. Where exchange dealers connect with electronic communications 24 hours a day, and the market's always open. And exchange quotes in different markets are not essentially the same. There would be an opportunity for arbitrage. So arbitrage used to be a big deal in the currency markets before things got very efficient with computers. And it's basically sort of, an arbitrage could be, here's a simple arbitrage that maybe you have done in your life. You take advantage of price differences. Maybe you go to Best Buy and there's an Xbox game on sale and you buy it for $39. However, then you walk over to GameStop and they're giving $45 for that particular game in cash. So you found the arbitrage, the price difference between what Best Buy is selling at and what GameStop is paying for it. So you can make a $6 differential by buying it at Best Buy and selling it at GameStop. Now, if you do that often enough, GameStop's going to adjust their price downward until a point where it's going to match or be below Best Buy's price if they get too much supply of a certain game. And that's going to take care of equalize the prices and arbitrage disappears. And in today's world, arbitrage may only stay around for a few seconds and only be fractions of a penny. But still, if you're a quick enough mover and you have computers, and this is how hedge funds at one point made a lot of money by taking advantage of this arbitrage across all these exchange markets. And most transactions involve in the world currency markets involve the US dollar on one side, because the dollar is what we call a vehicle currency, or a currency that is sort of a world currency, the closest thing we have to a world currency. And there's, for all the dollars inside the United States, half of those dollars exist outside the United States. In fact, some countries threw away their whole currency system and adopted the dollar. So if you go to Ecuador or Panama, they just deal in dollars. They are, I think maybe also El Salvador. They don't have a domestic currency. They just do everything in dollars. In many markets, foreign governments have to pay in dollars when they pay for things like oil, even though they're not, part of the United States. So it's just the way the world currencies work. Now, the currency exchange rates are important, and there's three factors that affect the movement of these exchange rates. One is a country's inflation. One is a country's interest rate. Now, inflation and interest rates are closely tied together. So let's think of this. If a country has a high inflation, they usually move to raise the interest rate to dampen economic activity to lower inflation. Now, if a country has a high interest rate, then a lot of foreigners may want to invest in that currency to get the high rate of return. But the interest rate has to be higher than the inflation of that currency, otherwise you lose most of the value. And there's also the market psychology of where they believe things are moving towards or going to, and where prices are going to be. Well, the speculation in the currency, which can change the value of them. So U.S. presidential elections oftentimes can have a big effect on currency. Depending on the political alignment of the president, one president may actually have policies set in place that will strengthen the U.S. dollar, and one president may have policies that could potentially weaken the U.S. dollar. And that certain policies of one U.S. president can be more favorable to another country's currency, and vice versa. So the U.S., since it's the most powerful currency in the world and most influential on exchange rates, who is president is also going to have a good, effect on the exchange rates. Okay. So how are prices related to exchange rate movements? So we have to really understand the law of one price and the theory of purchase price parity to kind of understand this concept. Now, so let's move forward. Law of one price. And the purchasing power parity. Let's just talk about these two because they're very important to understanding this. So the law of one price states that in competition, markets free of transportation costs and barriers to trade, such as tariffs that we talked about in previous chapters, identical products sold in different countries must sell at the same price when their price is expressed in terms of same currency. For example, if the exchange rate between the British pound and the dollar is £1 equals $2, a jacket retails for $80 in New York should sell for $40 in London because of this exchange rate. Consider what would happen if the jacket cost $30 in London, £30 in London, which should be the equivalent of $60 in United States currency. At this price, it would pay a trader to buy jackets in London and sell them in New York, since you could buy them for essentially $60 or 30 pounds in London and sell them for $80 in New York and make a $20 profit on each jacket. And because this is what we're assuming, that there's no transportation or trade barrier costs that would change this equation. So it's very important, the price of one law is to remember that. However, the increased demand for jackets in London would raise the price in London, and the increased supply of jackets in New York would lower the price in New York. So this would continue until the prices are equalized. Thus, prices would equalize in the jacket, and would cost essentially the same in both locations. This is also basically what I was talking about with that arbitrage between Best Buy and GameStop. Eventually, GameStop would get so many of these games that they would lower the price they're paying for them, and we get to a point of equalization. So basically, the law of one price. Now, purchasing power parity. If the law of one price were true for all goods and services, the purchasing power parity exchange could be found from any individual set of prices. By comparing the prices of identical products in different countries, it would be possible to determine the real, or what we call PPP, exchange rate that would exist in markets were efficient. An efficient market would have no impediments to the free flow of goods and services, such as trade barriers. So the purchase power parity is basically saying that this would be the true exchange rate based on your purchasing power. There is a famous example of this. Let me see if I can find it. Hold on. And The Economist publishes what they call the Big Mac Index, which is a version of purchase power parity, where it looks at the price of a Big Mac between different countries, and then it could calculate the local currency over or under valuation against the dollar as a percentage. So we see that in Mexico, there's 80% valuation increase in the cost of a Big Mac over what it cost in July. A more common look at this index, let's see, and it would show, the United States, the cost of Big Mac is $4.07. And then if we look at other countries, we could see how we can convert their local currency into dollars, and we can kind of see the implied PPP of the dollar against, what you pay for in the local currency. So we see that. I know I wasn't able to get a bigger image. It would show that, hold on, might be getting a bigger image here. I'm just trying to get, you can't really get the best image, but you could look this up on the internet, and it would show that, in some countries a Big Mac is a lot more expensive or cheaper than the United States, and that would show that there's parity between the markets. Okay. So the PPP will predict changes in relative prices in exchange rates. So when inflation is relatively high, our currency should depreciate. And if we can predict inflation rates, we can predict how a currency's value might change over time. So this is an important theory to give us a better understanding of the dynamics of a currency and how it's changing value based on inflation rates. So very interesting theory. So when there's a growth in the money supply, the greater the growth in output, inflation will occur. And there's been a big growth in American money supply, dollar money supply. And it's basically saying if there's more money in people's hands, they will buy more, which drives up inflation. I like to do an example called the Survivor example. There's a TV show, a reality show called Survivor. You may have heard of it. It was a very popular show at one point where they put people on an island and they got to fend for themselves, and they put them through games and different things. And so there's a one game where they give everybody $1,000 and they can bid on food. So a hamburger and fries, which normally would cost, say, $12, is suddenly hundreds of dollars because they have a lot of money and there's very little product for them to purchase in food. So the inflation in the prices of food goes up very quickly as they're bartering and they're putting together different bids on the food. So that would be an example of how too much money and not enough supply could create inflation. So let's see. Let's just go back to that concept. So this pricing power parity theory can predict changes in relative prices that will result in a change in exchange rates. So theoretically, a country in which price inflation is running wild should expect to see its currency depreciate against that of countries where inflation rates are lower, like the United States. If we can predict what a country's future inflation rate is likely to be, we can also predict the value of its currency relative to other currencies. Its exchange rate that's likely to change to. So the growth rate of a country's money supply determines its likely future inflation. Thus, in theory at least, we can use information about the growth of money supply to forecast exchange rates movements. Inflation is a monetary, fact of life, and it occurs when the quantity of money in circulation rises faster than the stock of goods, i.e., my survivor example. That is, when money supply increases faster than output increases, cash in the contestants' hands, and only one cheeseburger to bid on, prices are going to increase. So this is going to be just something that currency deals with. So this is a theory, and it's been tested quite often. Sometimes it's not 100% accurate, but for the most part, it's pretty accurate. Now, Fisher effect, when we're talking about exchange rates and interest rates, they are affected. And basically, how are they affected? And they're affected, because if a country has high interest rates, then people are going to want to bring money to that country to get those high interest rates. So the sum of it basically states that a country's nominal interest rate, the sum of the required real rate of interest, and the expected rate of inflation over the period for which the funds are lent is going to have this effect. So you're looking at, if interest rates are higher than inflation, the country is going to attract more money to be invested to get that differential between the interest rate and the inflation. As inflation comes closer and the interest rate come closer together, less money will flow into the country. And if inflation is higher than interest rates, money will run out of the country. So this is why the Fed's so important in monitoring and maintaining inflation and interest rates, so that we have a good balance, because it can really distort the value of the currency. And so if real interest rate is the same everywhere, any difference in interest rates between countries would express or reflect their expectations or realizations of inflation. If that was just a true one-for-one. Okay, so we're just going to move forward to this question. Investor psychology and the bandwagon effects. Are exchange rates influenced by investor psychology? And of course they are, because exchange rates are supply and demand, and if people feel they need to stock up on euros because the dollar is getting weaker for whatever reason, that's going to, that's their psychology. It may not be backed up by any facts. So the evidence suggests that the PPP theory for and the international Fisher effect is particularly good at explaining short-term movements in exchange rate. One reason may be the impact of investor psychology on short-term exchange rate movements. Evidence reveals that various psychological factors play an important role in determining the expectations of market traders as to likely future exchange rates. In turn, expectations have a tendency to become self-fulfilling prophecies. Now, one of the best currency traders is George Soros, and in '92, he made a huge bet against the British pound, and he borrowed billions of pounds using the assets of investments as collateral, and immediately sold these pounds for German Deutschmarks. Now, the technique was known as short selling, which is basically selling something first and buying it back later. So, which can earn speculator enormous profits if he's, buys back the pounds that he sold at a much lower rate than when he purchased them at. Sold them at. It's getting confusing, I know. I'll go over it again anyway. So basically, if he is if he sells pounds first So he sells the pounds, and then the pound devalues, and he goes back and buys the pounds to fill the hole he created when he sold the pound short, and the pound devalued, he make a lot of profits. So by selling pounds and buying Deutschmarks, Soros helped us start pushing down the value of the pound because now he's selling pounds, so it's creating too much pressure on the sell side, which is pushing the prices down in the pound on the foreign exchange market. Now, many foreign exchange traders, knowing that Soros is really good at predicting, jumped on the bandwagon, hence the bandwagon effect, and triggered the classic bandwagon effect where traders moving in a herd fashion in the same direction at the same time gain momentum, and the traders start selling the British pounds and purchasing Deutschmarks in expectation of the decline of the pound, and those expectations became self-fulfilling prophecy when massive selling forced down the value of the pound against the Deutschmark. And in other words, the pound declined in value not so much because of a major shift in macroeconomic fundamentals such as inflation and interest rates, but because investors placed bets based on the major speculator George Soros and what he was doing. And he made billions of dollars on doing this. Okay, so here's a quick summary. Relative money growth, relative inflation rates, nominal interest rate differentials are all moderately good at predicting long-run changes in exchange rates, but very poor at predicting short-term changes. Short-term changes in exchange rates are very volatile and happen quite often, quite consistently. So international businesses need to pay attention to these monetary differences between inflation and interest rates because of this. So exchange rate forecasting is an important tool. Now, so should companies invest in exchange rate forecasting services to help decision making? Yes and no. Depending on what school of thought you're in, you probably these services are often wrong. So that's why I don't really agree with investing in forecasting services. But you can see how a company needs to predict the future exchange rate variations, because of their business model. But the forward market and the swaps and the future markets are a better way of hedging these risks. All right, let's see. So before we talk about the efficient market, so like I was saying, it raises the issue whether it is worthwhile for a company to invest in exchange rate forecasting services to aid the decision making. And the two schools of thought are basically the efficient market school argues that forward exchange rates do the best possible job of predicting for forecasting the future foreign currency rates, and investing in forecasting services would basically be a waste of money. Just use the forward contracts. The other school of thought, the inefficient market school, argues that companies can improve the foreign exchange market estimates of future exchange rates by investing in forecasting services. In other words, this school of thought does not believe the forward exchange rates are the best possible predictor. Now, if a company is going to have a large investment in currency, they should really set up a forward contract or a hedge position to protect themselves from the change in the currency. Is basically my experiences in business. So I talked about this inefficient market where they really don't, see the futures markets as a good predictor, and they think that you should get your own service. And of course, if you want to there's two classic approaches to any type of exchange rate forecasting. One is a fundamental analysis where you are tracking economic forecasts and interest rates and monetary policy to really get an accurate judge of the change of the currency. And the other is a technical analysis where you're looking at trends and charts and past behaviors to figure out where the currency is moving towards. And these are also two very common investing approaches to stocks as well as currency. Um, and now, as far as converting currency, uh, most currencies are freely convertible, and you can, in most countries you can buy, whatever currencies you want. Um, Externally convertible only when non-residents can convert their holdings of domestic currencies into a foreign currency, and non-convertible when both residents and non-residents are prohibited from holding their from converting the domestic currencies into a foreign currency. So this is really has to deal a lot with government control, um, things about what they want their citizens to be able to do. And different countries have different controls on their currency. Now, some countries are worried about capital flight where money runs out of the country. So a country like China may have some non-convertible laws in effect where citizens can't easily convert their currencies to make investments in other countries because they're worried about capital leaving the country. And this, capital flight is most likely to occur when the value of a domestic currency is depreciating rapidly due to hyperinflation or economic, problems that the country may have. So some countries have, they want to limit the currency convertibility because they're worried about too much money leaving, escaping the country, and they may. They may turn to counter trade like barter agreements to trade goods and services rather than actually trading currencies. So as a counter trade. But generally, when countries try to limit the currency convertibility, citizens find ways of circumventing it, and that's why many countries where you weren't allowed to convert your currency, people still somehow managed to get dollars, and they would save in dollars and have them in their house because the domestic currency just wasn't really any good. So as far as a manager, for working in a business, you're going to have the problem of dealing with foreign currencies because just about all businesses are going to have to face this fact at some point if they're going to expand their businesses. So that you have to, as a manager, understand the influence these exchange rates have over your profitabilities. So if you don't manage your exchange rates and the dollar strengthens, when you repatriate foreign currency into the U.S., a stronger U.S. dollar, you have less profits. So the risk can be really put into a transaction, translation, and economic exposure. Transaction exposure is the extent to which the income from individual transactions is affected by fluctuations in foreign currency. So you could, if you expected to convert 100 euros into $150, but the euro declined and the dollar strengthened, maybe you're only going to get $75 for the 100 euros. So that's a real monetary loss based on that. Now, translation exposure, the impact of currency exchange changes on the reported financial statements. This could be how do you deal with, if you have a multinational company and you have, you may have different financial statements in different currencies, and when you have to, put them into one master P&L, that could be a translation exposure, and gains and losses from, are only affected on the paper because you're just converting it on paper at that point to show you what your total sales or profits are, but the money still really exists in the foreign currencies. They're not really in dollars, so that would be one thing. And economic exposure, the extent in which a firm's future international earnings power is affected by the exchange of exchange rates. So long-term effects of a declining dollar is usually very profitable for people to export a lot to foreign markets. And makes our goods actually appear cheaper in foreign markets as the dollar declines. So for an exporter in the United States, we like it when the dollar declines in value because it makes our products more cost competitive internationally, and it allows us to bring in more profits when we convert the currencies. Okay, so how do you reduce your exposure? Basically, corporations need to hedge. So what you could do is, if you know you're getting 1,000 euros are coming in next month, you can sell 1,000 euros today in a short sell, and then when you receive the 1,000 euros from Europe, you can buy them back. So that way you're guaranteed to get the exchange rate of today no matter what happens in the future. So there are ways that you can protect yourself from foreign currency risk changes in the future and lock in today's rates. And also buying forwards and using swaps can help with that as well, and companies do that. Now, other type of strategies is only repatriating the foreign currency when those foreign currencies are stronger. Maybe using the foreign currencies to pay for foreign currency liabilities in that country and not translating dollars over, and just creating a lag between the receivables and payables based on where you expect these currencies to move in the future. So it's a whole Treasury Department of a company can really manage these currencies as best as possible to make sure no money is lost in the exchange. So to reduce economic exposure, specifically to FX, which is foreign currency exchange, they can kind of distribute productive assets to various locations and try to not have all your exposure in one currency, and try to spread apart your currency risk among operations among many different currencies in the world. And a lot of countries are trying to diversify their reserves between dollars and euros. Now, the Greek debt crisis is, putting a lot of strain on the euro value, because they see that, if this Greek debt crisis expands to other EU members, could really raise inflation on the euro, and so the euro has been weakening based on what they see in the Greek debt crisis. So doing business in the European Union, you may be converting your dollars into your euros convert into less dollars as those euros weaken. So this could be a problem for companies to do a lot of business in euros. So there are many things that strategies that companies can take to sort of protect themselves in foreign exchange markets. And the first thing is really just to realize that this is a risk, and then develop policies and a mix of tactics to minimize it as much as possible. And that's really what any manager should be doing in the marketplace. If a company has a huge amount of foreign currency exchange, trying to detail where the foreign currency risks are going to lie in the future, which currencies are they building up, which currencies are going to need the supply of, trying to forecast or use good reporting systems to get a better handle on their foreign exchange exposure. And if a Eurozone goes into a recession like it's in now, other countries are going to be affected by this recession, and it's going to affect the orders and the trade between countries. So, currency is just going to be an outward reflection of how the internal economy is doing. Okay, so it's a key. You can see how currency is a key to international trade and international imports and exports, and most companies have to deal with these exchange rate differences. So an effective manager is going to be one that can really understand these markets and how to hedge against them to protect their company from any of these foreign currency risks. And it's also important that these managers know how to outline in detail and calculate the foreign exchange risks and express them to the owners of the business so they have an understanding of what potential problems could occur. Okay, so that is it for Chapter 10. I will see you next time. Take care.